If you locked in a mortgage rate anywhere close to 3% a few years ago, I want to tell you something that probably sounds strange at first. That loan sitting on your balance sheet, the one you might still think of as debt, is quietly one of the best financial assets you own. Not despite being a loan, because of it. I know how that sounds. We're trained, almost from the moment we understand what a mortgage is, to think of it as the opposite of an asset. A liability, a monthly obligation, a number that gets smaller and smaller as an accomplishment, something to eventually eliminate and celebrate being free of, ideally as fast as possible. And for most of financial history, that instinct made complete sense. Debt was expensive, rates fluctuated, and paying things down quickly genuinely protected people from risk. But something specific happened in the last few years that quietly flipped the math for a very particular group of homeowners, and almost nobody has explained it clearly, in plain language, without a refinancing sales pitch attached to it. So let's actually walk through why this is true, and more importantly, what it means for what you do next with the money you have available. Here's the mechanism, in the simplest possible terms. A fixed-rate mortgage locks in a borrowing cost for the entire life of the loan, typically 15 or 30 years, regardless of what happens to interest rates afterward, regardless of inflation, regardless of anything the broader economy goes through in the meantime. If you locked in around 3%, that number is frozen in place. It doesn't move. It doesn't care what mortgage rates climbed to since then, what inflation did to everyday prices, or what happened to the job market along the way. Here's why that frozen number quietly became so valuable. As rates rose significantly in the years that followed, the cost of borrowing that same amount of money for anyone signing a new mortgage today became dramatically higher than what it was back then. Which means, in very real concrete terms, the specific rate locked into your loan is now cheaper than what almost anyone else can access on a brand new mortgage. You are, in effect, holding a financial contract that would be genuinely difficult, maybe close to impossible, to recreate today at any price, on any property. That's the first reason this counts as a genuine asset rather than simply debt sitting on a statement. It's not really about the loan itself, it's about the rate attached to it, frozen in place, sitting well below the current cost of the exact same kind of borrowing available to anyone else right now. The second reason, inflation has been quietly working in your favor the entire time. Every year that passes, the dollar amount of a fixed mortgage payment buys slightly more of your income than it used to, because wages and prices tend to rise with inflation, while a fixed-rate payment, by definition, does not move at all. The mortgage payment that felt significant 5 years ago quietly becomes a smaller and smaller percentage of a typical income over time, especially if income has grown at all during that stretch, even modestly. Meanwhile, the actual property behind that loan has, in most cases, continued appreciating in value right alongside everything else. You're paying down a fixed, shrinking in relative terms number on an asset that's generally growing in nominal value the entire time. That combination, quietly compounding year after year in the background, is a genuinely favorable financial position, even though it rarely feels that way from the inside, sitting there each month writing the exact same check as always. The third reason, the opportunity cost of paying it off early has gotten dramatically larger. This is the part that surprises people the most, and it's worth sitting with carefully. There was a long stretch of financial history where paying off a mortgage aggressively, ahead of schedule, was treated as an obviously smart move, almost unquestionably so, repeated as near universal advice. That calculation has genuinely shifted for anyone holding a rate near 3%. If that same money, instead of going toward extra mortgage payments, could reasonably be expected to earn a meaningfully higher return sitting in an investment account over the same stretch of years, then paying down a 3% loan early is mathematically working against your own long-term interests. You'd be trading a return you could otherwise capture for eliminating a cost that was already unusually cheap to begin with. It's not that paying off debt is inherently bad or that debt should be treated casually. It's that this particular debt, at this particular rate, has become one of the cheapest forms of borrowing many people will likely ever have access to in their entire lifetime. Why almost nobody talks about this clearly. Part of the reason this idea hasn't spread widely is that it sounds, on the surface, almost irresponsible. Don't pay off your mortgage runs directly against decades of conventional financial advice that most people absorbed growing up, often from parents or grandparents who lived through a completely different rate environment. The advice wasn't wrong when it was given. It simply doesn't automatically apply to every era, and the specific era of historically low fixed rates that a lot of people locked into is a genuinely unusual one, unlikely to repeat anytime soon in quite the same way. There's also a psychological piece worth naming honestly. Debt, any debt, tends to feel uncomfortable to carry, regardless of the actual interest rate attached to it. The emotional weight of owing money doesn't automatically adjust itself based on whether that specific debt happens to be cheap or expensive. A 3% mortgage and a 9% credit card balance can trigger an almost identical feeling of unease, even though financially they represent two completely different situations. Recognizing that gap between how debt feels and what it's actually costing you is really the whole point of this video. So what does this actually mean in practice? It doesn't mean recklessly stopping mortgage payments or treating debt as something to chase on purpose. It means being intentional about where extra money goes, rather than defaulting to extra mortgage payments simply because that's the instinct that's always felt the most responsible. If you have a mortgage rate meaningfully below what you could reasonably expect to earn elsewhere, it's worth genuinely asking whether extra funds might build more long-term security sitting in a retirement account, an investment account, or even a straightforward emergency fund, rather than accelerating a payoff on a loan that's already, quietly, one of the cheapest financial tools available to you. This isn't a universal rule for every single homeowner in every single situation. Rates, personal risk tolerance, and individual financial goals all genuinely matter here, and this isn't personalized financial advice for your specific circumstances. But for a very specific group of people holding a specific kind of rate, the old instinct to pay it off as fast as possible deserves a second, more honest look. Here's what I think is worth sitting with as we close this out. Not everything that feels like debt is actually working against you. Sometimes the most financially useful thing sitting in your life is the exact thing you've been quietly trying to get rid of, simply because nobody ever explained why the math had already changed underneath it. So here's a genuine question for you. If you're holding a mortgage rate under 4%, has this changed how you're thinking about extra payments, even slightly? Tell me honestly in the comments. If this kind of honest, practical look at the financial decisions hiding in plain sight is useful to you, this is video 20 in an ongoing series here on Quiet Wealth, where we explore personal finance, financial planning, and the quiet math most people never get walked through clearly. Subscribing means you'll catch the next one. Thank you for spending these few minutes with me, and maybe this week take one more look at that mortgage statement with slightly different eyes.